Jason, please introduce our distinguished guest.
Thanks, Alan. We're on the phone now with Dr. Joseph T. Salerno. He's the academic vice president of the Mises Institute, professor of economics at Pace University, and the editor of the Quarterly Journal of Austrian Economics. Dr. Salerno, thank you for joining us on Butler on Business this afternoon.
You too. Thank you.
Well, in the time we have today, I really wanted to talk to you about the concepts of inflation, government debt, and your thoughts about the prospects for the U.S. economy going forward. And to start off, could you just explain to our listeners what is inflation and what does it do?
Inflation is an increase in the money supply. At least that was its original definition. Later on, it began to be defined as an increase in prices. But an increase in prices is really only one of the implications or effects of inflation. Okay, many other things happen when you have inflation. You have the interest rate being pushed down to artificial levels, which misleads people and investors and entrepreneurs into borrowing money and investing in ways that are really not sustainable. That are, they're just going to these various projects and companies that they're beginning to start or they're expanding will eventually become unprofitable once prices begin to rise as a result of the new money being injected into the economy, and the Federal Reserve System, which is our central bank, stops inflating the money supply. At that point, you have a recession, and the people who have been hired in the jobs that are working in these new projects and so on will then lose their jobs. So inflation is today defined as a sustained increase in prices, and the only cause of that is an increase in the money supply. And the only agency that's capable of increasing the money supply legally is the Federal Reserve System.
Well, thanks to the Fed, the monetary supply has absolutely exploded in the last 2 years. I mean, not to mention the last decade, but the headline numbers, if you look at what's reported, the core CPI, I believe, is in the neighborhood now of around 1.6% or so. It seems like the rules of how these numbers are reported and just the numbers in general that are coming out seem to paint a rosy picture that we don't really have a whole lot of inflation. Is this politics, or, I mean, do these headline numbers really give us an accurate picture of what's going on?
It's both politics and the numbers are constructed in a way that hide what the true effects of inflation. Just as an example, in the 1990s, they revised the figures by taking out housing prices and putting in instead rents, which weren't rising as quickly. They've also made something called hedonic adjustments, which means that if you buy a car with airbags, even if the price has gone up by 20%, compared to the cars without airbags, they would say, well, that's not really an increase in prices because you're getting a higher quality car that's more safe. So we're going to basically arbitrarily say that the prices really only went up by 5%. Because you're getting 15% more enjoyment. So they're fooling around with the figures that way. Oh, and one other thing they do is if the price of a high-quality beef goes up so that people shift to hot dogs, they will not take the full increase the price of beef. They'll say, well, people are spending less on hot dogs, so prices really haven't risen as that much. So you have all these manipulations that make the number itself smaller than it would be. And then there's a second thing that's almost as important, and probably more important, actually, and that's the fact that as our economy grows, if you had a sound money like a gold standard, you would actually have prices falling, like we have in the computer industry, like we have with high-definition television sets. Prices across the board would be falling. So the Fed pumps so much money in that it increases prices or prevents them from falling. So right there, if prices would have fallen by 5 or 6%, they've already raised them by 6%, and they're saying, well, they haven't increased at all, right, because the price level compared to last year is zero. But the point is that they've increased prices from what they would have been. So Americans, for example, in the late 19th century when we had a gold standard, actually enjoyed falling prices. Prices fell 2-3% every year, which meant that your dollar bought more. That never happens. Okay, so that's another way in which the inflation rate is calculated. It's calculated on the basis of what prices are today compared to last year, not what prices are today compared to what they would have been today if the Fed didn't increase the money supply.
Well, talking about naturally falling prices that might result from increased production, there seems to be a fear of deflation that's propagated. Even going back to Alan Greenspan, can you maybe explain this deflation phobia that they're pumping out?
Yes, in fact, that's a very good point. It was in 2002 that Bernanke came out with a speech, which was at first sort of overlooked. He wasn't the Fed chairman yet; Alan Greenspan was, and of course, so his talk had to be approved by Greenspan. So he gave a talk in Washington in which he said that if there is a deflation, and it probably will not be. Okay, he said that in the United States, like there was in Japan, he says we have the tools to fight that deflation. He says, even though there might not be, we may as well talk about what we can do. And basically, all of the unconventional ways of stopping deflation were just different ways of pouring money into the economy. And Greenspan then a few months later came out and said, we're getting dangerously close to zero, dangerously close to no growth in prices, meaning that the next step would be deflation. So again, we didn't really have deflation, but they were both trying to panic the American people into thinking that we were going to have deflation. Now, the reason why they did that was because the economy was recovering very slowly from the 2000-2001 recession, and Greenspan wanted to increase the money supply. And so he wanted a reason for doing that. And the reason was a fall in prices, a deflation. And in their minds, deflation means depression, which, of course, it should not mean. They're two different phenomena. So because in the 1930s we had both depression and falling prices, most mainstream economists, including Bernanke and Greenspan and so on, believe that one causes the other, that deflation causes depression, which, of course, is completely incorrect. It was the preceding inflation in the 1920s that caused a big stock market bubble and a real estate bubble, which, when they burst, brought about a recession that turned into a depression. That had nothing to do with falling prices. So basically, to get back to today's world, this what I call a deflation phobia, this unwarranted fear of deflation, is being propagated by the Fed so that they can just continue to increase the money supply, even though it's really not having much of an effect on getting us out of the latest financial crisis or recession.
This is Butler on Business, and we're talking with economist Dr. Joseph Salerno. Dr. Salerno, there's a term that's been thrown around a lot in the news lately, and that's monetizing the debt. But now it seems like the Federal Reserve, in my opinion, they are monetizing the debt. They're the largest holder now of U.S. Treasuries. What is monetizing the debt? Is the Fed doing it?
Well, monetizing the debt is basically just buying the bonds that are issued by government to finance the deficit that they're running. And I think last year, the increase in the amount of government securities owned by the Fed, the amount of bonds that they bought, pretty much matched the amount of bonds that the government issued to cover their debt. So even though they're directly not giving money to the government to finance the deficit, they're doing it by buying their bonds on the open market. So in effect, they are just printing money to pay for the extra spending above the taxation or above the tax revenues that the government's taking in. So that's monetizing the debt. I mean, that is in fact happening.
Well, what impact does excessive have on an economy? Why does it even matter?
It matters for a couple of reasons. One, the money that the government is borrowing for its wasteful, military adventures and its welfare payments and its corporate bailouts and so on, that money could be going into other productive ventures. In other words, if the government borrows that money, that money is not available for businesses to borrow, fund more research and development, build new capital goods, more factories and so on, create more jobs. So that's called crowding out. So in the near term, there's a tremendous amount of crowding out of private investment, which would make our economy more productive and would make the economy grow faster and would create more jobs. And in the longer run, of course, it means that there's going to be a massive transfer of wealth, okay, because somebody has to pay for these, the bondholders, their interest and the principal of for the people that have loaned the money to the government. And that's going to be the taxpayers. And so going forward in the future, and by the way, a lot of these bondholders, or 30-40%, are foreign bondholders, China, Japan, and so on. So taxpayer wealth in the future is going to be siphoned off, and that's going to decrease investment even more. So we're facing a real problem with that. I don't see them just stopping the inflation. Because at that point, look, we have to accept the fact that there's going to be greater unemployment. in the short run. If you stop the inflation, there's going to be greater unemployment. There's going to be business bankruptcies and bubbles bursting and more foreclosures. And I don't think that they have the political will to do that.
One of the other topics that I wanted to ask you about was that the U.S. dollar seems to get a lot of its strength from being the world reserve currency. A lot of the foreign banks hold U.S. dollars. A lot of the exchanges on the foreign markets are done in U.S. dollars. But it seems like nations like China and even a lot of the exchanges that are going on with oil are now moving away from the dollar. Do you see the dollar losing its world reserve currency status? Is that a possible scenario?
I see it being slowly dethroned from that status as other currencies become stronger relative to the dollar. The fall in the dollar has people worried. They're legitimately worried about that. They're not just making idle threats. We see the International Monetary Fund, the head of the International Monetary Fund calling for some kind of a system in which we have a world currency in which gold plays a part. So yeah, by the way, as another anecdote, it turns out that most of the U.S. currency, by the way, 80% of U.S. currency is outside our country, circulating in black markets, supporting drug transactions, and so on. And actually 80% of the $100 bills are outside the country. About 2/3 of our currency is outside the country. But my point is that very recently, even the drug dealers have begun to substitute 500 euro notes for $100 bills in making drug transactions. So there is a movement away from the dollar as a reserve currency, as a currency for making transactions on world markets.
Dr. Salerno, how can we begin to reform the international monetary system to keep money out of these destructive hands of government? I mean, what's the alternative? What can we do?
I think it begins with the United States. I mean, we're a large nation. We still have a very strong economy relative to the rest of the world. I think the first step we have to take is to take all regulations off of alternative currencies. So first of all, get rid of the legal tender law that forces people to demand to accept dollars for debts that have been contracted. So get rid of that. Then take all taxes, capital gains taxes, sales taxes, off of gold and silver, and then allow the banks to issue deposits to their customers in foreign currencies and in gold and silver. So it wouldn't be a complete step back to the gold standard, but it would set up all these alternative possibilities that would compete with the Federal Reserve dollar fiat currency that we're now stuck with. And so that we would be able to hedge against inflation. So if inflation did get worse, there would be a movement away from the dollar, and that would begin to restrain the Federal Reserve system.
Let me ask you one other question. A lot of our listeners have bought into the fact that we do have some substantial inflation coming down the pike. And, of course, if you've got some liquidity, you've got a lot of options. But what about somebody that's living paycheck to paycheck with very little money in the bank? How do they protect themselves against this onslaught of inflation we're about to face?
Ludwig von Mises, a great Austrian economist, he once said that, at some point we're all on the same ship, and you really can't protect yourself against it. The one thing that if you really do expect inflation, though, I mean, you can make purchases of certain things that you're going to find to be necessary in the future. You can make those purchases now and store them up. I mean, if you don't have a lot of money to put aside, to put in gold and silver and so on, because there's really nothing else that is really giving you a return out there right now. Putting it in commodities themselves, taking real things that you'll be using in the future is one way to go for people who are on restricted incomes.
Well, we've been talking with economist Dr. Joseph Salerno, academic vice president of the Mises Institute and professor of economics at Pace University and author of the book Money, Sound and Unsound. Dr. Salerno, we certainly appreciate your time today, and we thank you for being on Butler on Business.
It was my pleasure. Thank you.